Now let's talk about the key risks for Crown Castle, because even though towers are usually viewed as steady, the risks today are very specific. Number 1 is interest rates and refinancing. CCI is a capital-intensive real estate investment trust, so when rates stay higher for longer, your funding costs rise and the valuation multiple investors are willing to pay often compresses. That's why the stock can struggle even if operations look stable. Second is tenant concentration and the wireless capex cycle. Crown Castle depends heavily on a small number of U.S. carriers. If carriers slow spending, consolidate equipment, or renegotiate terms, growth can decelerate and churn can tick up. Third is execution risk around the strategic transition. CCI has been reshaping the portfolio and moving away from parts of fiber and small cells through major transactions. The market risk here is timing, deal execution, and what the new CCI earnings power looks like once the dust settles. And finally, there's the operational bridge. Until everything is fully transitioned, you can see friction, stranded costs, mixed changes, and pressure on reported growth. The core tower model is resilient, but today's risks are about rates, carrier behavior, and how cleanly management delivers the strategic reset. Now let's look at the opportunities for Crown Castle, and I'll split them into short-term and long-term. In the short term, the biggest lever is macro. If bond yields come down and the rate outlook improves, REITs typically re-rate fast, and CCI can benefit even without huge operational changes. The second short-term catalyst is clarity. If investors get a clean, credible story after the strategic review, simpler business, clearer cash flow path, confidence can return and the stock can reprice. And third, if the U.S. carriers move from a cautious capex phase back to steady deployment that supports leasing momentum and reduces fears around churn. Long-term, the bull case is still the tower model. Towers are basically digital landlords, long contracts, recurring rent, and built-in escalators. And as data keeps compounding, carriers often add equipment to existing sites, which is high-margin growth for tower owners. Over time, a stronger balance sheet and lower uncertainty could also open the door to smarter capital allocation, whether that's targeted investments, buybacks, or a more sustainable dividend policy. So near-term, it's about rates and clarity. Long-term, it's about the durability of wireless demand. Here we're looking at price to FFO for Crown Castle. Notice how the multiple looks higher recently, but that doesn't automatically mean the stock got expensive. A big reason is that reported FFO was pressured by the fiber side of the business, including restructuring and non-core noise that doesn't reflect the long-term earnings power of the tower portfolio. So the denominator got weaker. From a tower investor's perspective, today's multiple can actually be read as cheap towers, messy reporting. If execution improves and the business becomes cleaner, the valuation can normalize without the share price doing much. This chart shows FFO per share, and the recent drop is the key story for CCI. Towers are usually stable and predictable, but CCI's results have been dragged down by the fiber segment, where the economics and accounting have been less friendly. The market is basically saying, we trust the towers, but we don't trust the full package. If management successfully simplifies the story, whether through strategic changes in fiber, cost actions, or better returns on capital, FFO per share can stabilize and sentiment can improve fast. For income investors, this is the fix the narrative catalyst. Interest coverage is all about balance sheet safety, how comfortably CCI can pay interest from operating cash generation. You can see coverage is okay, but it's not a sleep like a baby number either, especially in a higher rate environment. That's why investors have been so focused on capital allocation and simplification. The good news, towers are resilient assets with contracted cash flows, so this isn't a liquidity story. The risk is more about refinancing cost and discipline. Keep leverage controlled, keep capex sensible, and coverage stays healthy. This is the dividend per share trend, and it highlights why CCI still attracts investors. The dividend grew steadily for years, reflecting the tower model, long-term contracts, escalators, and recurring cash flow. The question now isn't, did they pay dividends before? It's, how much flexibility do they have going forward? With the business under pressure from fiber-related issues and higher financing costs, the market wants to see stabilization first. If management prioritizes cash generation and de-risks the portfolio, this dividend becomes a stronger core income story again. Dividend growth is where you see the shift in reality. Earlier years show solid increases, but more recently growth slows, and that's a signal, not a surprise. In a higher rate world, REITs like CCI have to balance three things: dividend safety, debt cost, and investment returns. Slower growth isn't automatically bearish. It can be the responsible move while the company cleans up strategy and protects the balance sheet. If the tower side reaccelerates and the fiber drag fades, dividend growth can restart. But right now, the market prefers stability over aggressive raises. This payout ratio is the red flag chart, because it jumps when earnings metrics get temporarily depressed. And for CCI, that's exactly the point. Reported FFO has been impacted by fiber-related factors, so the payout ratio looks worse than the core tower's reality. Still, investors should treat it seriously. A high payout ratio reduces flexibility if rates stay high or if cash flow disappoints. The bull case is that this is a transition period. Fix the portfolio, stabilize FFO, and the payout ratio naturally improves. The bear case is prolonged weakness that forces tough dividend decisions. Let's look at the analyst rating for Crown Castle. We've got 2 strong buys, 9 buys, and 8 holds with 0 sells and 0 strong sells. So overall, the street isn't calling CCI a broken company, it's more of a cautious bullish setup. The split between buys and holds tells you something important. Analysts generally like the tower fundamentals, contracted cash flows, long lease terms, and long-term demand for mobile data growth, but they're still waiting for clarity on the fiber situation and the impact on reported FFO. That's also why you can see the stock looking cheap on some metrics, while investors still hesitate, because the market wants proof that management can simplify the story, stabilize cash generation, and protect the dividend. So the takeaway is, sentiment isn't negative, but it's not a full confidence, all clear either. If CCI delivers cleaner execution and improves the FFO narrative, these holds can quickly turn into buys, and that's where re-rating potential comes from. If this breakdown helped you, please hit like, subscribe, and drop a comment. Your support really helps me make more of these analysis videos. Thanks for watching, and I'll see you in the next one.